Hello and welcome to the 13th lecture of the course Forex in 3 steps. Today we will be jumping into the more advanced stuff and talking about pip and trade size. And this is crucial in trading. This topic is very crucial in trading, and trade sizing is something that is very important if you want to be an expert at risk management. And trust me, no one succeeds in trading without being a professional in risk management. First, let's take a look at how price movement is calculated in the forex market. Price movement in the forex market is not calculated in dollars, but it is measured in a unit called a pip, which is not point, percentage in point. Percentage in point or pip is the smallest change that can occur in the price of a currency pair. So again, a pip stands for percentage in point. It is a unit of measurement used to measure market movement. This is a simple table that explains everything you need to know about lot size and pips. Now you can ask me, what is a lot size? Lots are also a measurement or a tool used for sizing your trading positions. When you're entering a trade, the brokerage firm or the trading platform you're trading on always require or ask you what lot size will you do you want for this contract or for this trade. So you need to know how to measure it and how much exactly is a lot and how much exactly is a half lot and all of that, so you can position yourself and risk what and the amount you need per trade. So let's start from here. One lot is 100,000 units of an asset's price. Okay, keep that in mind. But in this table, we're trying to identify the value of one pip in dollars and the value of 100 pips in dollars compared to the lot size. So if you enter a trade and you choose to open a trade with one lot size, this means that each pip each pip the price moves, depending of course on whether it's moving against you or alongside you, you lose or win $10 per each pip. And that is considered a big position. Because again, like we said here, a pip is the smallest change that can occur in the price of a currency pair. So if I decide to buy Euro USD, I take a long position and price moves $1 up, then I earn $10. I'm in profit by $10. If it goes up by 2 pips, then 23, then 30. If it goes up by 100 pips, then I'm in profit by $1,000. Same thing with half, just everything in half. If you enter a trade with zero point 0.1 lot size, that means each pip is worth $1. So if the price goes in your favor by 100 pips, you earn or you're in profit by $100. If it goes against you by 100 pips, then you while your lot size is zero point 0.1, then you start losing $100. And you can also go to do the two decimal places in when it comes to lot sizing. If you use, for example, 0.05, then each pip is worth $0.5. If you even go, this is the least thing you can go, 0.01 lot size. This is the minimum you can go anywhere. And when using this lot size, it means each pip is zero point 0.1, which means that a total value of 100 pips is equals to $10. You can take a picture of this. It will all make sense as soon as you start trading and seeing these numbers and understanding them. This will be a good reference to come back to later when you fully understand it, so you can understand the values even more. Let's talk about calculating the number of pips. The first calculation we'll talk about is for the currency pairs that are made up of 4 decimal places, like for example, Euro USD. The formula here is that you take the first price, you subtract the second price, and you multiply it by 10,000. So, for example, I want to take a trade at this price, at this current price, 1.1567, and my target is 1.1513. I want to calculate the pips so I understand how much profit I'll make after this trade. So, again, I use this formula. I use this formula, which makes me take this number, put it here. This is the first price. I subtract the second price, which is my target, and then multiply it by 10,000, which equals 54 pips. And I can always come to this chart again and see, of course, depending on my lot size, I will understand how much I will be earning. So if I had entered this trade with one lot size, that means that I will gain $540 if my target is reached and my target is hit, which is 54 pips. The second calculation we'll talk about, which is very similar, it's for currency pairs that are made up of two decimal places. For example, USD JPY. For these pairs, we also take the first price, we subtract the second price, and we multiply it by only 100 and not 10,000. So for this example, if I want to also buy USD JPY and this time my stop loss, for example, is here at 104.7, then to calculate the pips, I will need to take the first price, I will subtract the second price, I will multiply it by 100, which equals $63. And this means if I had entered this trade with one lot size, this means that if I bought from here with one lot size with this price, and the price falls here and I get stopped out, I will have lost $630. The last type of calculation is for currency pairs that are made up of five decimal places. For example, the Dow Jones, which is made up of five decimal places. The calculation here is very easy. You just take the first price, you subtract the second price, and there you go, you have your total pips. How do we determine the value of a pip in dollars? The value of a pip in dollars depends directly on the lot size, as we said before, and as the examples we stated. The lot size is the contract value used to enter a trade ranging from 0.01 to 100. Lot size is what determines risk. The larger the lot size, the greater the risk. What about the value of a pip in dollars? The value of one standard lot is not always equal to 10 per pip in all currency pairs. Currencies and metals are all close to 10 per lot. For stocks and cryptocurrencies, the value of one lot equals zero point 0.1 per pip. And that is it for this lecture. I hope it all made sense, and it will make sense even more as soon as you start going into real markets and real price action. But for now, repeat this video if you did not understand. It will all make sense later on. See you in the next lecture.